Andrew and Joachim, we just had our 37th Secular Forum, and over the years we've come up with very valuable frameworks. If you think about it, the new normal in 2009, the new neutral in 2014, and then last year's pivot points. This year we're calling our conclusions rude awakenings. Can you, Joachim, describe what do we mean by that?
Yeah, well, rude awakenings, we came away with that because after the discussions with our external speakers, our global advisory board, and all the internal discussions, we came to a point where we thought, we may really be at a turning point for the global economy and for markets at this stage. We think the next 5 years could be very different from the last 5 to 10 years. If you look back at the last 5 to 10 years, the post-crisis environment, we had financial repression implemented by active central banks and by regulators. We had passive and sometimes restrictive fiscal policy. We had relatively free trade and capital flows. We had a low growth, low inflation, low macro volatility, low market volatility environment. So all of that tended to support financial markets. Now we think the next 5 years could be radically different on many fronts.
I want to now go deeper into those rude awakenings, and let me start with recession and start with Andrew. So Andrew, how likely is it that we're going to have a recession in the US and globally over the next 3 to 5 years? And what will that recession look like?
So we think it's likely you get a US recession in the next 3 to 5 years. We'd say it's part of the baseline, something we've been concerned about for a while. But late-stage fiscal expansion in the US and the possibility of the come down after the sugar rush means that 2020 and onwards, we see a good chance of recession in the US. Compared with history, it could be a shallower recession. You don't have the same imbalances that we've seen historically. It could also be a longer recession, though. It's hard to see that the central bank and fiscal policy space is there in the US in the baseline to quickly counter a recession.
Okay, Joachim, I want to now talk to you about productivity. And this was hotly debated because we've seen productivity be below average. But then we had one of our speakers, Eric Brynjolfsson, talk about how technology could help increase productivity. So where did PIMCO shake out on this debate?
Yeah, Anna, that was a very interesting session. I think our baseline view is that we will continue to be in a relatively low productivity environment over the next 3 to 5 years, but productivity is difficult to forecast, so we have to think about different scenarios. And one of those scenarios, which is maybe not very likely, but has a reasonable chance, is a surge in productivity growth driven by new technologies and by more capital spending, by more capex. But I think as investors, we should be careful what we wish for. The economists say productivity growth, stronger productivity growth is a positive because it raises living standards over the long run. That's right, but in the meantime, there are winners and losers, just as from globalization. And there might be a backlash from the losers. So we might see higher technological unemployment. And also, stronger productivity growth may lead to rising real interest rates, which could undo bond markets and also risk markets, which are priced off very low interest rates.
Great, thank you. Let me stay with you because I want to talk about fiscal spending. You've seen fiscal spending increase in the US, and this should increase growth, and yet we are calling it a rude awakening. Can you explain why fiscal spending should be seen as a rude awakening?
Yeah, well, I think there are two reasons. The first one is debt levels, particularly public debt, and especially in the US, but also elsewhere, has continued to rise since the crisis. So that means we are starting with expansionary fiscal policy from much higher debt levels. We're piling on additional debt, and at some stage, investors may not be willing to buy that debt at currently low interest rates. So I think this raises the potential for higher risk premia and steeper yield curves over time. The second related aspect is that central banks, which were very supportive, kept interest rates very low, also because fiscal policy was passive or even restrictive, may change their policies. We may see more rate increases by the Fed, and again, that could then disrupt markets. That's why I think the changing fiscal and monetary policy mix could lead to a rude awakening.
Andrew, I want to ask you this because we talked about populism and how it can have different impacts depending on the type of populism. Can you describe to us what was our debate and how can investors prepare themselves for this type of risk?
We think that navigating markets the next 3 to 5 years, political factors are going to be very important, always important, but populism, more difficult challenges will be even more important. We're seeing this already in the US. You've had populist policies from the Trump administration. The response from the financial markets has been quite positive in some cases, for example, on the tax cuts and the equity market response. But going forward, particularly in the next slowdown, we think that populism is going to be a more significant risk. So on one side, economic nationalism, protectionism could be a growing threat in terms of global markets, but there's different sorts of populism, maybe more wealth distribution, potential risks in terms of nationalization, threats to central bank independence. So on both sides of the political divide, there are populist risks.
Okay, so the last rude awakening I want to discuss is geopolitics. And this is for Joachim. When you talk about geopolitics, you have to talk about China. And we saw this year during our forums that we were a little bit more positive. And we discussed how China could be seen as a stabilizer for the financial markets. And at the same time, there were some who talked about the Thucydides trap and how when you have that, you could have conflict when a rising power challenges a ruling power. So can you describe our views on China and then also discuss the relationship between US and China in terms of trade?
Yeah, so on the first one, China is probably less of a source for financial risk on a global scale. The main reason is that they've clamped down on capital controls. Also, power in China has moved back to the center, from the local authorities to the central government and to the president. And that means China will be better able to control particularly the capital outflows. So less of a risk for the global economy from say a disruptive exchange rate depreciation, for example. At the same time, we think Chinese growth will slow. That's quite normal for countries that are approaching middle income status, that growth slows. But it will probably be slowing in a controlled fashion. So much for China. Now, the bigger worry is the geopolitics. So as you've already mentioned, if there is an emerging power that challenges the established global superpower, then this tends to lead to conflict. In some cases, even armed conflict. We've seen that in history. We do not think that there will be a war between China or the US over our secular horizon, but there is a swelling underlying conflict because China has become a challenge for the US economically, technologically, and also geostrategically. And that could lead to continued eruptions on the trade front and conflicts of different sorts.